Hello, I'm Greg Bunnell. Welcome to Market Call tonight. Our guest is Tim Nash. He's founder of The Sustainable Economist. He wants to take your calls and emails and tweets on renewable energy stocks and green REITs. So give us a call. It's toll free, 1-855-326-6266. You can send an email to marketcall@bnnbloomberg.ca, or you can tweet us at Market Call. Welcome to the program, Tim. I believe this is your first Market Call.
That's right. Yeah, I'm really excited to be here.
Welcome to the show. We're going to have lots of fun. A very interesting topic.
Yeah.
And of course, when I think about green investing, we've had this idea for a couple of years, and we've seen it sort of grown. But now we have a bit of a shift, don't we, in terms of the politics moving to the right, to some conservatives who aren't as excited about green projects.
That's one way of putting it. I think that definitely we are seeing some barriers. I mean, it's been really fascinating tracking the growth of the green economy. I've been following it for about the past 10 years, and it's really grown tremendously, really has moved towards the mainstream. And I think it's really interesting to watch as, you know, with Donald Trump thinking that coal is going to make a comeback, probably not the best economic strategy there. And then obviously now with Doug Ford coming in, really moving backwards on a lot of these green energy programs. So it's a little bit of a disappointing time right now for green investors. Really, I would argue that it's a short-term sort of slowdown. But when I look at this from a long-term perspective, there's no doubt in my mind that these represent some tremendous investment opportunities.
When I think about some of the moves, these are the political moves, and those passions can flip back and forth in as short as 4 years, obviously. But when it comes to corporations, I mean, a lot of big companies, even including a lot of the big oil companies, have been making pushes into cleaner, more renewable energy. I don't imagine they stop that just because there's a provincial government in Ontario. I mean, in the United States, that was a big change in the United States.
Yeah, I mean, I would point towards the car industry as one that's really going sort of full steam ahead, forgive the old expression. I don't know what the electrified version of that is, but when I look at cars investing in electric vehicles, every major car company is now moving ahead with hybrid electric vehicles. We're going to have hybrid F-150s running around. If that doesn't represent sort of a major change in terms of how corporations are addressing these issues, I don't know what does.
And so in the longer term, then, you're optimistic?
Absolutely. And I think, again, it's really easy to get caught up in the short-term political cycles right now. We're in a bit of a time warp, I think, with Donald Trump. It feels like every day there's some new news. You know, when you think about this 24-hour news cycle, right now it really is quite prevalent even with Doug Ford. Looking at it day in, day out, there's always something new coming up. And it's so easy to get caught up in that short-termism. I try to do my best to take a very long-term approach. I kind of joke I'm not a day trader, I'm a decade trader. So what I'm looking for, opportunities that right now might actually be considered a little undervalued, right, due to the short-term political news. But when we look at this from a long-term perspective, there's no doubt that this is the direction the economy is growing. And quite frankly, if you accept the science behind climate change, it's not a question of if the economy transitions in this way, but how quickly it will. Certainly right now, we want to tread carefully. You know, it's going to potentially move a little more slowly over the next election cycle. But really, these investments are moving forward. You talked about it on a corporate level. I'm certainly seeing it in terms of emerging markets. So China is investing heavily in this direction, India as well. And really, I'm a little bit sad. I feel like there's a bit of a lost opportunity for Canada. We were very well positioned at the forefront of the green economy, and now all of a sudden we're taking 3 steps backwards.
All right, interesting start to the hour. We'll be back with Tim Nash, founder of The Sustainable Economist. He wants to answer your questions about renewable energy stocks and green REITs. So give us a call, 1-855-326-6266. I want to give you that number again one more time if you're listening to us on the radio, 1-855-326-6266. We have an email from John in Oakville, wants to talk about Brookfield Renewable Energy Partners. What is your opinion on what Brookfield's doing here? Is it a long-term buy and a hold for dividend income and growth?
Yeah, so I really like Brookfield. I would argue that they're probably the largest of these yieldcos, so these renewable energy utilities here in Canada. I love the fact that Brookfield has the backing of Brookfield Asset Management, so it's a really, really large firm. I feel that this is a bit of a safer play, specifically if you're worried about the sort of short-term political risk in this sector. They own a tremendous amount of hydro, wind, solar power. They own 2 thermal plants that do burn natural gas. So for people that want to be 100% fossil fuel free, there's a little bit of nat gas in their portfolio. But I really like this play. I probably bought into this, I'd say about 3 or 4 years ago. For me, it's more of a dividend play. I love the dividend. I think there's potential for growth. As some of these assets continue to appreciate and looking at more government contracts in this area. Also really excited about their ability to scale globally. In terms of acquiring projects, I know they've got a few in Brazil, and really see this as a name that I would feel comfortable owning into that long term.
Well, when it comes to wind power and the technology that's there, I think it's been painted with a somewhat negative brush in Ontario because of some of the contracts, which were quite expensive, that the Liberal government signed up for. If it's done right, can wind power be a nice, profitable part of your portfolio?
Absolutely. I mean, and again, these are, when we look at the players that own the renewable energy assets, it really is a play on those longer term contracts. There are companies that do the wind turbines themselves. So Vestas Wind Systems would be a name in terms of a wind turbine manufacturer. But really, I like these projects. The costs are coming down quite dramatically. So although Ontario certainly, you know, they were the first contracts.
Top dollar early in
Early on.
In the game,
and I mean, that's really the price you pay to be an early adopter, right? I think the thinking there was, let's get these companies here in Ontario, let's get them comfortable with the climate, knowing that there's lots of wind opportunity here in Ontario. Sadly, now there are going to be new contracts, and we're certainly seeing some of the bigger firms that had contracts, looks like some of them might get canceled. So that's not going to help business investment in this area. But really, I do feel that there is tremendous opportunity in wind. We know right now, whereas the price of solar has been declining dramatically, wind is competitive with a lot of traditional systems. The issue is really going to be the reliability. Oftentimes, wind blows when we don't need the electricity. So late at night, during the winter, those are times where wind power is strongest. And so really what we're going to be looking at is updating our grid, in improving energy storage, if we really want to be able to make use of the wind assets that we have.
Let's take a call from Mary in Burlington. What's your question, Mary?
Hi, Greg. Hi, Tim. Thanks very much for taking my call. Tim, I have some shares of Interjex Renewable Energy that I received because I was an Algonquin Power holder. Okay. And I just wanted to know, it's been ticking along quite nicely. I was hoping you would think that it was one of your 10-year stocks. So I'd like your opinion. Thanks very much. I'll hang up and listen.
All right, Interjex. Nice yield on this one, 5%.
Yeah. And that's what I'm saying here, that there are some really nice dividends to be had in this sector. Interjex is a great play, really like them, 100% renewable energy. And really, I do feel that they do have the ability to grow as well as generate that nice yield. So I like this company as a pure play when it does come to renewable energy. Again, I think that there are few places where you can get this nice of a dividend without taking on some of the carbon risk that we're going to be talking about a little bit later. I know there are a lot of pipeline people that own pipeline stocks, and there's a lot of risk that comes to that. Comes with that. So I really like Interjex. I would put them as a bit more of a growth play than Brookfield, but certainly, take that dividend year in, year out.
All right, the street says 4 buys, 5 holds, 1 sell on Interjex, and they have a $16 price target. That would be 17% upside from where the stock closed today. We have Jerry in Toronto on the line. What's your question, Jerry?
Good evening, gentlemen. Tim, my question's about TGOD, T-G-O-D, the Green Organic Dutchman cannabis stock. So I was wondering what you think about it from a valuation point of view. Do you hold it? Do you think it has some competitive advantages over maybe the more traditional cannabis stocks, which most analysts seem to feel are way overvalued? Would you think it might be a good long-term hold? And Greg, I don't know if there is a consensus, but if you could find that, I would appreciate that as well. Thanks so much.
What do you think about organic marijuana versus marijuana?
Yeah, well, I mean, so I do like this play versus a lot of the growers. I think one of my big fears when it comes to this sector is that it becomes a commodity, right? And if it becomes a commodity, really it's going to be about the cheapest producers. Right? So if someone like Philip Morris wanted in on this industry, I mean, they know how to grow things very cheaply without maybe the best labor standards and certainly using a lot of chemicals. Right? Whereas when it comes to the organic space, I do think that consumers are going to be willing to pay a premium, both for value added, so whether it's looking at things like edibles or sort of more of the upmarket brands that can go direct to consumer, but also I think that a lot of consumers are going to care about the supply chain. There was a study that came out by a firm called Sustainalytics earlier this week where they looked at the top 4 growers. So Canopy was in there, a few of the other big ones, and their sustainability scores were shockingly low. These are companies that weren't paying attention to CO2 emissions, to labor standards. They didn't have adequate policies sort of across the board when it came to environmental, social, and governance issues. So I really think that there is an opportunity here for companies that take these things seriously. My guess is that their target audience is really going to care about a lot of these issues. So the fact that they can be certified organic, I think consumers are going to be willing to pay a premium for that.
Very interesting. As far as the street's concerned on green organic Dutchman holdings, there's only one analyst following the name, but that one analyst likes it. He says buy, and he's got a target price of $9.20 on the stock. That'd be a considerable jump from the $5.79 that we closed at today. We'll be back with Tim Nash, the founder of Sustainable Economist. He's answering your questions about renewable energy stocks and green REITs. So give us a call. It's toll free, 1-855-326-6266. We have an email from Rob. He wants to talk about First Solar. What do you think of First Solar, Tim?
Yeah, so First Solar is the biggest name when it comes to solar panel manufacturers, at least certainly when it comes to the North American market. Their stock, they've gotten nailed twice. So first they got nailed during the crash. So, we saw everything fall, but we saw renewable energy fall substantially more than a lot of other sectors. But then they got nailed again, I'd say in about 2012, because China went big into the solar panel market. And they started producing solar panels at a really, really highly subsidized area. And they decided they wanted to be the global leader in solar panel manufacturers. And so we saw a big decline when China went in. So this is an interesting play because as much as I think that there is going to be growth in sales for them, the price of solar panels continues to fall dramatically, which is great for you and I or anyone that wants to put solar panels on their roofs. I love the fact that solar panels are getting cheaper, but from a manufacturing perspective, they're the ones that have to accept those lower prices. So to me, this is something, if you're willing to ride it out for the long term, if we think that there is going to be sort of a green boom to some degree, where investors are going to give a higher multiple to renewable energy companies, then I can see this doing very well. It is a big name in this space. At the same time, you're going to have to be patient on it because we are going to see prices continue to fall, and that there is the potential for a really dramatic technological change in solar panels. We're seeing the technology move very quickly where it's becoming more efficient.
Yeah, this idea that everything we build as we move forward in technology ends up being smaller, lighter, faster, cheaper. I wouldn't expect solar panels to become bigger, clunkier, and more expensive.
You got it. And so, we're talking about having solar panels that will now be a coating on windows.
Wow.
Thin film, right? So in that area, if you're producing the older, sort of clunkier solar panels, it might not sell as well. So I'd be a little bit cautious. I like it as the biggest player if you want to play in the solar panel market, but I would be a little bit cautious about the technology risk.
Right now, the street on First Solar says 7 buys, 8 holds, and 3 sells. We have Dave on the line from Toronto. What do you got for us, Dave?
Hi, thank you again for taking my call. I wanted to ask about Ecolab. So I see that a lot of people are talking about this stock because like it has a lot of growth potential. So I'm a young investor, and I just wanted to ask, I guess, what do you think about it in the next 5 years? Is it going to be like one of those like five beggars where it like multiplies like really big? Because like I heard that Bill Gates is backing up this company, and like they're making a lot of progress on like really like good investments. So what do you think about it on a long-term horizon? I think it's important to keep a long-term horizon on this stock. And can I get street consensus as well? Thank you.
All right, thanks, Dave. Ecolab, what do you think?
Absolutely. So I would see this, I see a huge opportunity when it comes to the water space. And this is a company that is involved with a number of different, basically, water technologies, safe food, abundant energy. So to me, it's really, this has the opportunity to grow tremendously. Again, this is technology, right? So we're counting on two things. Number one is corporations continuing to care about providing the safest, cleanest products and services, but also continued government regulations in this area. Now, it's a little bit concerning looking at the U.S., looking at the Environmental Protection Agency. Again, they've moved 3-4 steps backwards since Donald Trump was elected. So this is one now. What's encouraging to me is that the stock has continued to do really quite well during that time. So I would be a little bit cautious. This is a play where if we assume that companies are going to keep moving forward, that municipalities will keep moving forward, then I really like this play. I think they're producing a lot of really innovative products. I don't know if I'd call it a five-bagger over the next little while, but I think it has that potential. And I mean, certainly if you're looking for a pure play in the sort of the growing green economy, this name is fantastic.
And I would like to think that whether your politics are left or right down the middle, you enjoy some clean waters.
Well, right? And healthy food. I mean, these things are absolutely important to us.
11 buys, 12 holds, and 2 sells on Ecolab. The 12-month target price of $153 and change. That would be 9% upside from where it closed today. We have Nick in St. John, New Brunswick on the line. What's your question, Nick?
Good evening, gentlemen. I wonder, can I get your opinion of precision drill? I've been holding for quite a while. Any life left in this stock, or what do you see in 12 to 18 months? And can I get the strict consent? I'll hang up and listen to your answer. Thank you.
Sure thing, Nick. Thanks.
Sure. So I think I'm troubled by this stock. I think that as we move forward with continued oil and gas exploration, is going to become increasingly more expensive, just in the sense that if we are worried about climate change, we're going to have to leave a large percentage of our fossil fuels underground. Now, right now, it's still a lot of people aren't really paying attention to that. The sort of drill, baby, drill mentality is, I think, very strong. But I would be highly, highly cautious, specifically if we're serious about meeting the Paris Agreement. And we can argue, we can debate. I don't know if people are serious about meeting that agreement. But if we are, I think we're going to see a huge reduction in oil and gas exploration and drilling. What's interesting about this technology, though, is that it's the same exact technology they use to drill geothermal wells. So there's a tremendous opportunity.
It could be a pivot.
Yeah. Exactly. And so Alberta has tremendous geothermal potential, right? Around the world, this is really nice base load power. So it would be an interesting, that's what I would sort of be keeping my eye on from a green perspective. But if we're looking at their existing technology and assuming that this company needs continued resource exploration in order to remain profitable, I would be really cautious here.
All right, Precision Drilling. The street has 13 buys, 6 holds, and 1 sell on the name. Pardon me. We'll be back with Tim Nash, founder of The Sustainable Economist, answering your questions about renewable energy stocks and green REITs. So give us a call, toll free, 1-855-326-6266. Since it is Tim's first time on Market Call, we don't have any past picks to go back to, so let's take a look at some of the bigger themes you're watching. You talked earlier briefly about this idea of a carbon bubble and the risk that it presents to Canadian investors. Explain that to me.
Yeah, that's right. So if we accept the science behind climate change, the climate is changing, that CO2 emissions are rising dramatically, and that this is causing a lot of the wacky weather that we're seeing across Canada, certainly this summer, then really it begs the question that are we going to be able to burn all of the carbon that companies currently have sitting in reserve? So if we were to look at the balance sheets of a lot of the large oil and gas companies, they've got these reserves, proven reserves, we know they're down there. If they pull that oil up and burn it, if they execute their business plans, we're going to shoot past all of these different climate targets, and we're going to be in a world where we're looking at 4 degrees, 5 degrees, 6 degrees warming, which is a huge, massive problem. So as governments start to take it a little bit more seriously, there is the risk that these assets will become stranded. And whether it's by government regulation or simply due to the economics, if we have a price on carbon, and I know there's a big conversation happening.
There's a pushback as Saskatchewan and Ontario are on the same side on that file now, and it's the opposite side.
And it's the bad side from where I sit. That in my mind, we need to price. There is a market failure right now in that there is, with no price on carbon, we know that's a negative externality. Classic economics tells us that we need a Pigouvian tax that is going to reduce the consumption of fossil fuels. If that happens, right, which most economists argue should happen, and if that carbon tax gets high enough, it won't be economic for them to be able to pull that oil out of the ground. In that scenario, we're looking at a carbon bubble of roughly $20 trillion.
Yeah, we had a graphic up on the screen, so maybe we can bring it back and you walk us through that graphic.
Sure.
Some of the numbers are
highlighted. I mean, so you know the real estate market, right? You watch that. So if we look at the housing bubble in the U.S., right, looking at a bubble of about $7 trillion, right, in terms of the U.S. home equity in 2009 and then kind of after the decline to 2009. We're in a scenario now where scientists tell us that we have a certain carbon budget, that if we're serious about keeping that Paris Accord agreement, that we can burn roughly about $7 trillion worth of carbon. However, our current carbon reserves are sitting at about $27 trillion, right? So there's a lot of oil that now, through the shale gas revolution, right, a few years ago, there was this notion that we were going to hit peak oil. That's not the case. We've gotten so much better, so much smarter at finding new sources of oil. The problem now is that really, if we were to burn all of that supply, we're going to be in deep trouble from a climate perspective. And so
how many years of runway would be on that supply? Because I'm thinking at the speed that technology moves, if we get to a place with electric cars and other modes of energy that become cheaper than burning carbon.
This is it. So this is the International Energy Agency is doing a lot of work in this area. And they've been quite conservative in terms of their predictions around electric vehicles and renewable energy costs being decreased. So, I mean, it's really tricky, but we're at a point now where we know we're not going to run out of oil. We know that. So the problem is now whether it's through lower demand because of electric vehicles, whether it's through a higher price due to a carbon tax, there are a large number of reasons why we might want to keep that oil underground. In that scenario, we need to be really deliberate about winding down those fossil fuel reserves. If it were to go to happen too fast and sort of happen all at once, investors are going to get burned. Really, really, really serious by this. Mark Carney, when he was governor of the Bank of Canada, identified this as a major risk. When I look up the makeup of the Toronto Stock Exchange, right, if I own my TSX 60 ETF, there's a lot of oil and gas, there's a lot of materials, a lot of mining that have these carbon assets, and there are a lot of banks, and our banks here have really heavy exposure to those sectors. So again, I don't see this happening in the next couple of years. Right? Want to be really deliberate about this? Absolutely. But if I'm looking at my investment portfolio with a horizon of 20 years, 30 years, 40 years, it's undeniable to me that we're going to be taking more serious action on climate change. And if that is the case, if I'm right, then we're going to see a serious write-down of a lot of those carbon assets currently sitting on the balance sheets of these publicly traded companies.
Fascinating stuff. A lot to think about there. We're going to be back with Tim Nash, the founder of The Sustainable Economist, answering your questions about renewable energy stocks and green REITs. So give us a call. It's toll free. 1-855-326-6266. We have Jan on the line from Calgary. What's your question, Jan?
Good afternoon, gentlemen. I hold Algonquin Power, and lately we've been up and we've been down and we've been all around. And I was just wondering if Tim might have some ideas what's happening with it, and if there might be any M&As looming in the near future. Thank you ever so much, and you gentlemen have a great weekend.
You too, Jan. Thanks for the call. Algonquin Power.
So Algonquin Power is definitely one of these yield cos that I really do like from a dividend perspective. I think that they do have a fair bit of natural gas in their portfolio. So again, not a pure play when it comes to renewable energy, but certainly for people that are looking to maybe sort of take a step towards green investing, this company makes a lot of sense. I don't have any information when it comes to mergers and acquisitions. Sorry, Jan. I wish I did. I think that to me, a lot of the volatility in this space right now is more on the systemic level. It's kind of due to the broader stock market. I think I saw a lot of these yield cos do really well a few years ago when there were some jitters in the market and people were really looking for that nice fat dividend yield. I think that right now there's a real tension where some people are looking for growth plays and it's sort of risk on. Other people are sort of, worried about an impending crash and so risk off. And so I think that it's really more the broader investment community kind of needs to get their head wrapped around some of these higher dividend stocks. Certainly, I really like Algonquin. I think it's slated to do well. And again, it would be sort of one of these medium steps where it's not a full renewable energy play, but kind of a step in that direction.
All right. As far as Algonquin is concerned, I don't know anything about potentially what they might want to buy if they did, but I can look at their balance sheet, and they had $3.8 billion of debt on the books at the end of March for a company that's only valued at $4.6 billion in the market. So there's a lot of debt there. Yeah. Let's take a question from Valerie, sent us in an email. Ballard Power, should I keep holding on? Here is one of those early names in the space that people have been very frustrated with.
Very frustrated with. And I think a lot of people feel burned by a lot of energy storage companies. That so Ballard is a play on hydrogen fuel cell technologies, which makes a lot of sense. I mean, the technology is sound. Unfortunately, I think they went heavy towards automobiles. That they were looking at, fitting every car with hydrogen fuel cell and having stations sort of around the country, just like we have gas stations. And that really hasn't happened. And I would say that the automotive sector has really consolidated around lithium-ion batteries as that sort of nice, easy electric play. Everyone's been waiting for the big breakthrough when it comes to batteries and energy storage. And I think where the market has landed is that we're going to go with the best technology, which right now is lithium ion. We're just going to make it as cheaply as possible. And that's really the competitive play. So I really worry about Ballard. I know they're taking some steps to be able to move a little bit more towards financial sustainability and profitability. Unfortunately, I think a lot of people bought them with this sort of explosive growth in mind. And that just simply isn't happening in terms of the car market. Where I see much bigger opportunities when it comes to hydrogen are things like ships. When it comes to marine power, right now they use a lot of this really heavy, nasty diesel. They call it bunker fuel, right? And to be able to shift from bunker fuel to hydrogen, to me, makes a lot of sense. Really, you're looking for places where it's centralized storage. The biggest issue when it comes to cars is how do you get it in people's tanks? We're not going to build all that infrastructure. So having it in a seaport where the ships are going to be anyway, in my mind, makes a lot more sense.
Very interesting. Stock closed at $3.96 today. Of course, it's been a long time since it was at this value, but in the year 2000, it hit a high of $165. Ballard Power. We have Karen on the line in Toronto. What's your question, Karen?
Hi, thanks for taking my call. I just want to know what you think of Polaris Infrastructure Fund. It's dropped so low, so is it really a good time to buy it? Thanks.
Polaris Infrastructure. Let's take a look.
Sure. So this is a geothermal play. This is really looking at creating renewable energy solutions in Latin America. So it's listed on the TSX, but my understanding is that a lot of their operations are in, I think Nicaragua is where I see their existing play. So this is very much a growth play. This doesn't have a lot of assets right now. I think I only see one project that's currently up and running. That said, I do see tremendous opportunity here. Really what we're seeing, one of the big problems when it comes to renewable energy adoption here in Canada is that we already have all this infrastructure, right? Our grid has been built, all this stuff exists now, whereas when we look at a lot of poorer countries, right, they're building out this infrastructure right now as we speak. And so just like we saw a lot of regions bypass all the telephone wires, right, and just leapfrog that technology
right into cell
and just go right into cell phones. In the same way, I think there's a tremendous opportunity for a lot of countries to bypass these massive plants, this highly centralized system that we have right now that requires so many wires and infrastructure. And if they can leapfrog and go directly into renewable energy sources, I do see a tremendous opportunity there. Now, obviously, there's going to be a little bit more political risk in those countries than we're used to, right? So which is why I would consider this much more of a growth play than a lot of the other renewable energy utilities we've seen that are a little bit more of a dividend play.
6 analysts follow Polaris Infrastructure. All 6 say buy, and they have pretty high hopes when it comes to the stock price. Their 12-month target price is $26 and change. That'd be a jump of 120%. We'll be back with Tim Nash, the founder of The Sustainable Economist. He's answering your questions about renewable energy stocks and green REITs, so give us a call. It's toll-free, 1-855-326-6266. We have an email from Jim in New Westminster. He wants to talk TransAlta Renewables. Should I sell now and cut my losses? So Jim is clearly not happy with his investment here.
Right. Well, and again, I would say that, really this is a company I would own for the dividend. So this does have a nice fat yield. And what I would say is now with the stock price down, the yield has probably jumped up considerably. So this is one where, you might want to consider, lowering your average cost per share and increasing your dividend by buying a little bit more now. TransAlta is a fascinating company. I mean, they're primarily a coal utility. They had all these wind assets and they spun off their wind assets into a separate company. Which I loved because for a long time this was 100% wind energy projects. Unfortunately now they've included a bunch of their Australian natural gas projects in this as well. So for a lot of my clients that wanted to be fossil fuel free, now I'd say about 41% are these natural gas projects. 41% of their portfolio is natural gas in Australia. So, I mean, from my perspective, I don't love it. I tend to like the pure play renewable energy stocks. That said, I do think they do have a lot of opportunity here. Again, backed by a bigger name. I know that they're not going to be short of cash. Really, it's just going to be about what types of projects, what is the strategic direction of this company moving forward. I thought I had clarity on that, and then they threw me for a bit of a loop.
All right, depending on how long Jim has held the name for, he might feel burned by the dividend as well. It was an 18 cent dividend in early 2016 before they cut it down to 4 cents on the payout. So if he's been hanging around that long, that probably got him angry as well. When you cut a dividends and you're relying on that dividend.
Yeah, absolutely.
Right, we got John in Montreal on the line. What's your question, John?
Good evening, gentlemen. My question's on Westport Fuel Systems. About a decade ago, there used to be Westport Innovation, and the stock took off into the high 40s in regards to their R&D and improving the emissions and when it comes to truck engines. Since then, the bottom's fallen out. I wonder if they'll ever get share market again. Do you like this stock? Would you take a position? And Greg, please, if I may, consensus. Thank you, gentlemen. Have a nice weekend.
Yeah, look at the long-term view of this chart. It's hit the 40 mark twice, right, during the tech bubble, and then it came down, and then it hit it back again in about 2010, 2014 area, somewhere in that, and then it came right back down again.
Yeah, so, I mean, you really have to be careful with these technology companies when it comes to this space. Every so often, something comes up, and it becomes a bit of a darling of the green, renewable energy space. And everyone thinks this is going to be a full market transformation where everything is going to move in this direction. And again, this is one where natural gas makes a lot of sense to be able to convert some of the, some of the transportation systems, right? So I've seen a lot of long-haul truck drivers where really this has saved them so much money by shifting from diesel to natural gas. With natural gas prices as cheap as they are, right, they've saved a tremendous amount of money. That said, I don't see it being a major movement in this direction. It seems to me that electrification is kind of seeing, and again, I don't want to bet on a technology here.
I guess that's the problem, right? Like people for a while, they were excited about Ballard Power, and that one didn't become the big technology. So you get excited about this. Maybe this won't be the all-encompassing big technology.
Absolutely. And natural gas is really seen as a bridge fuel, right? So right now, it's lower CO2 emissions than a lot of conventional fossil fuels. But it's always going to be more carbon intense than electrification. I mean, it depends on the grid, but assuming that electricity generation moves more in a greener direction, that really, I don't know what role natural gas is going to play in this transformation. And again, it's really hard. Companies tend to have a really hard time with the upfront costs when it comes to switching their fleets. So even if we know the payback period on switching all of your trucks from diesel to natural gas, is going to be short and it's going to be profitable, all that money has to come up front, right, with the savings over time. And we're seeing that there are a lot of psychological barriers when it comes to that upfront cost for a lot of these green initiatives. So I would be a little bit cautious. Again, Westport Fuel Systems, I like them. I don't think they're going to transform the system. At the same time, I do see them as a nice medium-term solution until we do move towards full electrification.
As far as the street's concerned, 4 analysts follow the name, 3 say buy, and 1 says hold. We're going to take a quick break, and then we'll be back with Tim Nash, founder of The Sustainable Economist. He's answering your questions about renewable energy stocks and green REITs, so give us a call. It's toll free, 1-855-326-6266. Right, we got a email from Murray. He wants to talk Questor Technology. What do you think about this name?
So Questor is a really, really interesting company. They work with a lot of existing oil and gas companies, and they've got a very efficient process for recovering waste heat. So they talk about clean combustion. So if we're going to be burning things, right, there's a lot of waste. Sometimes it's in the heat, sometimes it's in the byproducts. What they're really good at doing is capturing that waste and being able to turn it into new energy forms. So it's a bit of an interesting play here because I can see, and they are an Alberta company, so I can see their fate being tied to the fate of Alberta's oil sands. That if those companies continue to do well, and if we see the oil price go up, that they're going to be looking for ways to become more efficient. I really like this technology. I think it's a way, since we're going to have fossil fuels for the next little while anyway, a way of making them a lot more efficient. That said, again, if I'm looking at this from 10, 20 years' time, would want to see them pivot to be able to capture other forms of waste.
Very interesting name indeed. Questor Technology. An email from Bob wants to talk hydrogenics. I'm getting an education tonight. Hydrogenics.
Yeah. So this is another place in hydrogen energy technology. I like them more than I like Ballard because I do think that they're moving more towards larger forms of transportation. I talked a little bit more about marine. I think they're also looking at trains as well. And again, places where there needs to be a central fueling station. Hydrogen makes a lot of sense. Basically, you're taking a form of electricity. So whenever the grid is active, when there's really high supply on the grid, they can take that electricity, convert it into hydrogen, and then be able to burn that very, very cleanly, and the only byproduct is water. So the technology makes a lot of sense. I really like it. What I would want to see is more of these large transportation sectors with a genuine interest in reducing their CO2 emissions. Sadly, a lot of the transportation sectors, because they are international, they don't fall under any one country's jurisdiction. And they've been a bit of a funny area when it comes to things like the Paris Accord, where they often stand outside of that because they are interjurisdiction. So to me, it's like, I love the technology. I worry a little bit about it because I don't know if the companies that would be adopting this technology necessarily care that much, again, to be able to make the upfront investments in these cleaner technologies. We know it's going to pay off for them in the long term, but do the boards have that foresight to be able to make a commitment to a specific technology right now?
And another email, this one from Chris, wants to talk about pattern energy. What do you think about this one?
So pattern energy, this is an interesting one. This is one that got hit, I would say, pretty hard by the Doug Ford announcement. I noticed that it was down a fair bit on that day. My understanding is that they've now got a partnership with Brookfield. So again, they've now got sort of a little bit more of a solid backing that I like. My understanding, this one I think has a really, really nice dividend. But we can see on the chart, when it did come down earlier this month, I think that was on the heel of the announcement.
Yeah.
So I don't, I'd want to double check with their portfolio. I didn't see their name listed in terms of specific projects that did get canceled. This is definitely something, a pure play renewable energy projects that I would want to own for the dividend, and then hope that as more investors are looking for these green energy stocks, that their share price would be able to recover a bit from where it was.
Yeah, when I take a look at a note that came out from Goldman, you're right that when the shares pulled back, it was the Ontario announcement, but a Goldman analyst said that only 5 of the 758 projects were wind projects and none were associated with pattern energy, so he thought that the sell-off was overdone.
Absolutely. I mean, most of those projects, I looked through the list, most of them were things like schools, First Nation projects, community-owned projects. There were a few churches that were putting up solar panels that were included in that list. It's really, I don't see this really affecting too much. Obviously, what it's going to do is it's going to push the investment out of Ontario. So these companies are now going to be looking to be able to develop projects in other jurisdictions. I don't think anyone's really looking at Ontario to be able to develop new projects with the current government in place.
And as you said, the yield is attractive. Pattern Energy Group has a dividend yield of 9.7%. We'll be back after this short break. Top picks coming up next. It is time now for top picks, the basis of past picks when you're back in about a couple months. The iShares Jansi Social Index ETF, the XEN. Tell me about this one.
Sure. So this is the standard bearer when it comes to socially responsible investing in Canada. So what they're trying to do here is track the TSX 60. But get rid of what I'm going to call the most evil companies. So what they do is they do this sustainability analysis looking at environmental, social, and governance issues, and they drop out the bottom 20% of each sector. So you're still going to have lots of banks in here.
I was going to say, we've gotten rid of the most evil, but by some people's estimations, and I'm not one of them, I just don't get angry at me, but Royal Bank, Toronto Dominion Bank, Suncor is in there. So we still have big traditional companies.
You got it. So this is, I would say, sort of a step in the right direction. That if someone wants exposure to the broad Canadian market, but does want to make sure that they're investing in companies that are leaders in this area, or at least avoid companies that are the laggards in these areas, then this is a great pick. It's done well compared to the traditional TSX 60. So when I talk about socially responsible investing, most people automatically assume that you're going to get lower financial returns. And this is a very clear-cut example that by doing this sustainability analysis, getting rid of the companies that have the lowest sustainability scores, you can actually outperform the traditional benchmark.
All right. BCE is on the list too. and I don't feel so bad about that. They're my employer. Ultimately, we are owned, of course, by BCE. The next one is the Invesco Clean Tech ETF, the PZD. Let's take a look at this one.
So this one, this is a tech play. This is clean technology. So I really worry about picking and choosing individual technologies when it comes to the green economy. So many people have gotten burned over the years that really this is a way to be able to invest in the broad clean tech
and sort of
sector.
Spread it around. So if one of them fails, it's not the end of the world.
Not the end of the world. So this is going to have a little bit of renewable energy. This is going to have a little bit of water infrastructure, some smart grid, some environmental services, really nice, well-rounded ETF. I expect this to do well as we do move into a green economy. And again, if you don't want to pick and choose those individual companies, this can be a nice way to get that growth exposure without putting all your eggs in any one basket.
All right, this final name might surprise some people for green investing, but Cascades.
Yeah, I love this company. Cascade, to me, it's a paper company that doesn't cut down any trees. So they use 100% recycled paper. They really understand this whole closed loop thinking. So they're looking to identify efficiencies throughout the entire process. And I see this as a really great opportunity in terms of the paper play as facilities. So it's not so much the consumer play that I like. I mean, I think some consumers care about this stuff, but I'm seeing a lot of facilities, building owners, companies, as they try to sort of brandish their sustainability and kind of credibility. You know, one of the things I always look at is, you know, when I go into a restaurant or I go into a building and I can see what kind of toilet paper they've got, if they're using Cascade paper, I know it means that they're considering the entire environmental life cycle. And I'd also add that food packaging, we're seeing tremendous movement in this area. So,
all right, Tim, we got to say goodnight.
All right.
8 seconds left on the clock. Thanks for joining us this week. Pleasure having you here, Tim.
Thanks.
Come back and watch us next week. It's great.